Good morning from London. I'm Anna Edwards alongside Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. The UK Chancellor looks to slash billions in spending. We'll look ahead to Rachel Reeves' spring statement as fresh CPI data crosses the terminal. Traders weigh up prospects for a bigger Russian role in commodity markets after Moscow and Kyiv agree a ceasefire in the Black Sea. But some key details are still unclear. Plus, US copper futures surge on a Bloomberg report that President Trump could slap import duties on the metal within weeks.
We're, of course, going to be diving into those very stories. But in the meantime, a quick check on these markets because the futures picture is virtually unchanged. If you look at this board, it looks like a giant nothing burger. But I promise you, a lot of the action is actually showing up in the currency picture. Anna just talked about the CPI numbers crossing the wire. 129 handle on cable hasn't really changed to 107 on Eurodollar. We're going to talk about these market dynamics. The countdown to the opening trade starts right now.
Welcome to the programme. It is Wednesday, the 26th of March. We have a lot to talk about when it comes to commodities, but for the moment, let's talk about what's going on in the UK. And the CPI number in particular, we get that breaking, and the pound is dropping. It is down this morning by 0.2%, as we see the inflation number come in lighter than had been expected. So, Kriti, we thought we could see a print of 3%. The prior number here was 3%. We could have seen that again. That was the survey. Instead, we get 2.8%. That would be welcome relief to the Bank of England as they try to bring that inflation rate down. Well, and they don't have to write a letter to the Chancellor of the Exchequer and explain why it is not under control. It will be welcome relief politically as well, because one of the things that's hanging over the Chancellor as she gets ready for her spring statement, yes, higher interest rates, yes, sluggish growth, but also the prospect of inflation remaining high. Will it tick up from here, though, is something we can't dismiss. Bloomberg Economics still saying that it could peak at 3.8% a little bit later on this year.
So those are the CPI numbers on a year-over-year basis. Then you look at the core CPI, and you're seeing a drop there as well, from 3.7% last month to at 3.5% this month in the latest readings as well. I think the spring statement is a fascinating one because not only is the UK talking about how it's going to have to deal with some of the domestic pressures, which you outlined, but the international ones as well. One of the touch points there has been things like the digital services tax, among other places where you might see holes in the budget, but are really a reflection of how the UK is handling the geopolitics with the rest of the world, and specifically the United States.
Yes, and there will be plenty of attempts to blame the international situation, and that does take some of the blame here when it comes to higher interest rates, Trump policy, perhaps even German policy, having an impact, having a ripple across the Atlantic or across the Channel. So we'll certainly watch that. But the domestic story around welfare cuts, defence spending, that debate will rage, and we'll bring you all of the latest on the spring statement later on today. Kriti, let's move on to some of the commodity-related news that we need to cover this morning. We'll leave copper for the moment, but in terms of some of the soft commodities and gas and oil, we are firmly watching what is happening in the Black Sea.
Absolutely. The grain basket of the world, 25% of grains prior to the war in Ukraine that began, comes from the combination of Ukraine and Russia. This has been an area of contestment, I should say, and it's also been an area that has a direct read-through into the inflationary pressures in the UK, in Europe, but also in the United States as well. So a lot of economic watchers may be relieved to hear of a partial ceasefire, specifically in the Black Sea, one that Turkey has had a part in negotiating. This actually does have an impact on things like grain exports. So you've seen that reflected, for example, in the likes of wheat contracts, where you have seen that pressure ease a little bit. This is going to reflect in things for everyday consumers like cereal, bread, etc. Not immediately, but potentially in the long term if it holds.
But yeah, if it holds, and if in fact it is as it first appears. There's a lot of detail that's missing here. So the Russians saying that this depends on some sanctions being lifted. Specifically, they want access for their Russian agricultural bank to the SWIFT payment system, of course. Now, the US is saying that they will help Russia access world agriculture and fertilizer exports, decrease insurance costs, access ports and, crucially, access payment systems. So does this mean that Russia is going to be let back into SWIFT? And does this Black Sea deal depend on that happening? And if so, where does that leave Europe? Because Europe has shown no sign of wanting to lift the sanctions environment on Russia.
Absolutely. It's going to have a reflection. I'm curious to see how this shows up at the market open as well in terms of some of the shipping story as well. We've had the likes of Maersk, for example, Hapag-Lloyd talk about the issues in the Red Sea. But the Black Sea and the Mediterranean has been an area that they've kind of thought of as an easy problem to solve. solved because you can just reroute in a different direction. I wonder if that shows up in some of the shipping prices available to some of these companies.
We should not take our eyes off what's happening with the tariff conversation, should we? And stateside, a lot of that focused on copper. Yesterday, our reporting suggesting that we could still be waiting, and it could come soon, a copper tariff. So that is a tariff on imported copper into the United States. This is something that President Trump has talked about in the past. He's talked about or threatened a 25% tariff on these imports. And as a result of this news flow just yesterday, New York copper prices hit a record. Now, I'm drawn to the Markets Live blog in moments like this because Jake Lloyd-Smith has some great lines on this, saying that copper prices globally are basically one hot mess right now. And he's talking about the disparity that we're now seeing, the big gap, the chasm we're seeing opening up between LME contracts for copper and New York contracts for copper. As the New York price rises, that incentivizes a lot of copper to go to the US. That's in danger of leaving China short of copper for actual production activity, and it could lead to stockpiles in warehouses over in the US. So we'll certainly see how this one plays out. That premium in New York could have a big impact on the way that this particular commodity is traded.
And you can see that gap on your screen at the moment between the New York contracts and the other contracts as well. It's worth noting that, again, this has a ripple effect into a lot of the miners that are listed right here in the States, because from a global perspective, Chile, I think, is the largest copper producer in the world, which is interesting because I believe China is the largest copper consumer of the world. So how does that change those kind of tariff dynamics there? But then also it's going to show up in some of the pricing ability that you are seeing in some of the European corporates like Rio Tinto, like Glencore, like ArcelorMittal, among many, many others. So again, plenty of geopolitical news in the commodity space, not only going to be affecting the commodity contracts, but of course the equity market right here in Europe as well.
Let us talk about some of the things that are coming up in the programme. We've dealt with the UK data this morning in the shape of that inflation print. We will get to the spring statement. And with analysis ahead of that spring statement, we will also be talking to Laurence Mutkin, BMO head of EMEA Rate Strategy, who's pretty bearish on gilts of late. So we'll get into the details there. Ejikeme will join us. Carmignac, fund manager, will get a perspective on how he is seeing the world right now with this shifting tariff picture. Jackie Inniker joins us, Spring Investments CIO. A lot to say about the global banking space, in particular the Swiss banking sector. We'll ask about UBS, some interesting news flow and some of our reporting around UBS and its options. Meg Hillier also will be with us, or specifically with Lizzie Burden, who is out and about covering the spring statement for us. The UK Treasury Select Committee chair will be speaking to the programme about what we can expect in that spring statement.
Plenty of really great conversations ahead on the program, plenty of data as well. As Anna mentioned, that UK spring statement kind of feels like the key flashpoint right here in the UK this morning at 12 p.m. There's a couple of other data points to bring about, though. At 12:30 p.m. UK time, the focus may shift to the United States. We do get those durable goods data later today as well, and a debt ceiling date from the Congressional Budget Office. Now, remember, the thought here is that we're going to be kicking the ceiling kicking the debt ceiling conversation down the road to July. We may or may not see that priced into the bond market, but in the meantime, we're also still digesting plenty of other data, things like the U.S. consumer confidence numbers from yesterday.
Yeah, absolutely. That's a crucial conversation, though, around the debt ceiling, so we'll continue to watch that. In terms of the consumer confidence yesterday, yeah, we're just going to be looking for any clues of cracks for the U.S. consumer, because we've seen this breakdown between the survey data that has been weak, and we saw that once again yesterday, a 12-year low on consumer confidence, expectations, that is, sorry. So that certainly has caught some people by surprise. It's raised some eyebrows. But as yet, and this is something that even Chair Powell at the Fed referenced just last week, we've seen a disconnect between the survey data and the actual, data coming through on the market, the actual data. And so until it is reflected in some of that hard data, it is difficult for the markets perhaps to attach too much importance to it, although we did see it dominate the conversation yesterday.
Well, these consumer confidence numbers almost affect the inflation expectation numbers, which are then affecting the market pricing around the Federal Reserve, because, again, the market is starting to think, well, maybe the Fed is a little bit late to the game here. You heard some similar comments from the likes of Raphael Bostic over at the Atlanta Fed in the last couple of days, speaking to our very own Michael McKee. It's also worth noting that in the same time as you talk about the data and the economic data and the potential debt ceiling conversation, there's also one to be talked about in terms of potential tax cuts coming in the United States. And that's going to be perhaps a boon to a lot of the consumer angst around the potential impact of tariffs.
OK, from tariffs, let us get to some of the other stories that you need to know this morning. Santander has become the first EU bank in almost a decade to be valued at more than 100 billion euros. That's as investors increasingly pile into the banking sector. Europe's banks have had their best winning streak since before the turn of the millennium. Shares have been soaring in recent years after the ECB ended a period of negative interest rates in 2022, giving a massive boost to bank profitability. CK Hutchison is said to be going ahead with the plan to sell 2 Panama ports to a BlackRock-led group. Bloomberg has learned the parties aim to sign an agreement by April the 2nd, with the sale netting $19 billion. China has criticised the deal, with Beijing directing officials to investigate potential national security and antitrust violations. And Mario Draghi says Germany's decision to increase defence spending is, quote, a game changer. But the former ECB president and ex-Italian prime minister has warned of risks on how it's implemented. Draghi also said it's not in Europe's interest to retaliate against US tariffs. That's because it's far more reliant on trade than the United States or China. And this conversation, Jemana Besetcha, our colleague, talking to Mario Draghi over in Hong Kong, I think it was, at the HSBC event that we've been at for the last couple of days. Really interesting. And it's interesting to see somebody with his stature adding weight to these arguments that, yes, OK, it's great to have this pile of money, and he does sound optimistic, calls it a game changer for Germany to spend. But at the same time, it depends how it is spent, and it depends on doing that well. We talked to Moritz Kramer just a couple of weeks ago, who was really saying, look, even in times when there were no issues around German debt, they couldn't spend the money fast enough. Yeah. You need the bureaucracy to work to allow the money to get out the door. Well,
we'll see if this is the maybe exception to that rule that we see around Germany as well. He also made the comment that if Germany is successful in doing this, in the game changer move that he calls it, can the rest of Europe actually follow? So we've been talking about it from a market perspective, simply that this German fiscal spend is going to have ripple effects outside of Germany as well.
Yes.
He's making the argument that there's a concern around consolidation, of course, in the defense industry that could result in Germany going far ahead in that goal and the rest of Europe falling behind.
And I think the timing of these impacts is really important, because yesterday we talked about how this was something of one of our guests telling us that this was something of a freebie, a bonus for the rest of Europe, the fact that Germany was going to spend so much. In the short term, though, and you can ask Rachel Reeves perhaps about this, and other chancellors and finance ministers around Europe, in the short term, it's pushed up borrowing costs in Europe. Has it yet delivered anything on the growth front? Maybe it's too much to expect it to deliver very, very quickly, but that'll be something. We'll need to bridge that gap between the two for it to turn out to be a net positive for Europe.
Absolutely. What do they do with that extra fiscal spend? And is this the perfect time for it? And that some of the costs are coming down, some of the inflationary pressures are coming down. Does a potential energy crisis on the horizon change some of those dynamics? Coming up, we're going to be diving into that very concept, where the CEO of Shell said that the energy company will continue to look for potential acquisitions, however, warning that the risks in pursuing a major deal still exist. We're going to bring you some of that conversation later in the program. Plus, we'll take a deeper dive into the standoff between UBS and Switzerland's top banking regulator over its capital requirements. But up next, we're going right back into the markets and the economics. We're joined by Isabelle Job-Bazille, chief economist over at Credit Agricole. If you have any questions of your own for us or for our guests, get involved in the conversation. IB plus Bleeby TV Go is the function on your terminal. This is Bloomberg.
Welcome back. This is the opening trade, 7:16 here in London this Wednesday morning. This is the picture for European equity market futures then. We are expecting a little bit of upside. We went higher in Europe yesterday and in the United States, in fact. US futures, though, I should note, point a little bit lower. Here in Europe, we will be waiting for the spring statement from the Chancellor for the UK markets. That's certainly going to be crucial. Over in the United States, no doubt we'll be watching for any further lines on tariffs or Ukraine. Now, the US President Donald Trump says he plans to limit exceptions to his tariff push. It's the latest cryptic hint about a planned April 2nd announcement of reciprocal duties on global trading partners. For more on this, let's bring in Bloomberg's Valerie Teitel. And just over the last couple of trading sessions, Valerie, it seems we've managed to make gains in risk sentiment because of expectations that these reciprocal tariffs won't be too tough. He'd said he was going to cut some countries some slack, and now he seems to be dialing that back a little bit. Read the tea leaves for us.
Anna, I mean, reading the tea leaves, reading through these cryptic messages from Trump, the equity market seems to be on a more firmer footing in dealing with these tariff headlines, at least for now. We've notched 3 days of gains for the S&P 500, which doesn't sound very strong, but it's something, Anna, we've not seen in nearly 2 months. So celebrating 3 back-to-back days of gains for the S&P 500, up some near 2% in those 3 sessions. The equity market really not rattled by the latest from Trump. There is one market, though, that is completely rattled by what we're hearing from the Trump administration, and that is the copper market. We're seeing new record highs for the COMEX copper. That's the New York futures traded, the copper futures that are traded. We're seeing this divergence between LME and COMEX, which is something we normally do not see. So very unusual to see this kind of price differentiation happen. This is happening because U.S. manufacturers, U.S. companies, even U.S. traders are rushing to import copper ahead of tariffs, which we've now learned could be in a matter of weeks instead of in a matter of months. There is another data point I want to talk about, and that is consumer confidence. I know you mentioned this briefly, Anna. Consumer confidence did miss yesterday, and we also saw a decline in the expectations component. This is a 6-month forward component of consumer confidence. It hit a 12-year low, but still the equity market read through this. I think that's telling us, Anna, that we really need to see this consumer confidence in the doldrums impacting consumer spending. And to that, guys, we do get that PCE data on Friday. That is the personal consumption data. Maybe the market is waiting for some hard data to confirm the recent slide in consumer confidence in the U.S.
Thank you very much, Valerie. Bloomberg's Valerie Teitel. Perfect place to kick off our conversation with Isabelle Job-Bazille, who's Chief Economist at Crédit Agricole. Isabelle, very nice to have you with us. Let's focus in on the U.S. consumer for a moment, because as Valerie was telling us, a 12-year low in consumer expectations over in the United States. That sounds dreadful, but at the same time, as she said, the hard data not necessarily telling the same story. How do you read the U.S. consumer at this point?
In fact, thank you. Good morning, first. And in fact, we all try to estimate actually the impact of the tariffs and Trump policies on inflation, on growth. But I think we missed something of paramount importance, is the question of the impact of uncertainties on confidence. And we see now the result, and confidence is a key ingredient for a smooth functioning of the economy. And the loss of confidence we've observed now in the US on both the business and the confidence sides could be self-fulfilling and could plunge the economy into a vicious cycle. That's why we remain quite cautious about growth prospects in the US.
So is that caution leading you to conclude something that looks recession-like, or is it just a kind of normalization in the US growth story, Isabelle?
It's difficult to say this. I would say that, of course, the risk of a recession has increased. But as you mentioned, we can't see that for the moment in our data. Maybe our data will change in the coming days. But for the moment, it's difficult to say that. But in the same time, you have probably deceleration in growth at a time when inflation remains quite elevated. So it could raise again the topic of stagflation. So I don't believe in the risk of stagflation, because I think at the end of the day that this deceleration of growth, probably more pronounced than expected, will exert downward pressures on inflation, and probably will lead the Fed to cut rates before the end of the year.
Isabelle, there's a question right now in the United States of a potential tax bill that's coming down the pike, one that could offset the effect of tariffs domestically for the U.S. consumer. Is there a possibility of a positive ripple effect that if the American consumer spends with more, say, tax relief, that might have a positive effect in growth for the rest of the world?
I'm not so sure, because if you have tax cuts, in fact, it is the extension of the Tax Cuts and Jobs Act decided during the first term of Mr. Trump. So the situation will not change that much in terms of purchasing power and lower income tax. So I'm not so sure it will be a boost for consumption. And as I mentioned, you still have this trade-off between this and, of course, this question around confidence and the loss of confidence given the surrounding uncertainty.
Isabelle, we talked plenty about potential inflation risk emanating from the United States. Let's talk about inflation risk emanating from Europe and specifically from Germany. There's been so much excitement around this kind of demand push from the German fiscal spend story. How inflationary could it be? And at what point does that inflation risk get into dangerous territory?
So it is obviously a question, and as you have observed, we have already this steepening of the yield curve, which is recently, and it is an issue for the ECB because we are still in a monetary easing cycle, and if you have this sharp rise in long-term interest rates, this is causing an unwarranted tightening of financial conditions. So if situation persists, but I don't believe for the moment that we have the first risk is a risk of inflation. Probably it will boost growth, obviously, but maybe a little bit more inflation, but not that much. And at the end of the day, I think it will be an issue for the ECB if situation persists. Some things will have to be done, and probably the ECB may decide to stop the quantitative tightening in order to relieve the pressure on the long end of the curve.
OK, so that's how the ECB responds to German policy. What about US policy, Isabelle? How much concern do you have for the European economy as a result of tariffs? Because the range of expectations around just US tariffs is huge. But then you add in any secondary tariffs the US might impose, or any retaliation that we might see from other geographies. And the whole thing becomes quite difficult to pin down.
So we have tried to make some estimates of the potential impact of those tariffs on the European economy. I would say that we have taken, in terms of assumption, a 10% increase of tariffs on all products and some measures of retaliation. And at the end of the day, the impact remain modest, about 0.2 to 0.3 percentage points of growth over 2 years. So it's not that much, but it is a lot if you consider that we still have a weak growth in Europe of about 1% for the moment. So it means that 1/3 of this growth could disappear because of these tariffs.
Isabelle, in your previous response to kind of the German fiscal response, you also talked about the idea of kind of tightening and potential levers like QT, for example. Walk us through, again, in a follow-up to Anna's question there around the tariff response, how much does liquidity out of the ECB matter right now? Is that still the driving force in supporting not only these markets, but, of course, the economy?
But in fact, I would say, OK, it's obvious a question, but I would say the right question to ask is to know the bargain Trump will try to engage with Europe. We know perfectly well that Trump used the tariffs to leverage and achieve some objectives that are not related to trade. It was what we observed with Mexico and Canada on the immigration and fentanyl control. So the question is now, what is the topic at the heart of this negotiation with Europe? And my guess is that Trump is going to negotiate with Europe to relax its regulation on digital service, the DSA and the DMS, so the Digital Service Act and the Digital Market Act, and I would say that we will see what's going to happen, because we have in Europe a very powerful tool, which is the anti-coercion instrument that could be used to give the right response to Trump.
Isabelle, pleasure to have you on the program. Chief Economist over at Crédit Agricole. We thank you so much. Coming up, we're going to dive into the UK rates market ahead of that spring statement. This is Bloomberg.
Welcome back. This is the opening trade. The futures picture for Europe then looks like this. We are going to factor in a little bit of upside, it seems, at the start of trade. So Euro Stoxx 50 futures up by 0.4%. US futures had been negative, now actually almost entirely flat stateside. So there we are. We'll be waiting in the UK, of course, for the spring statement from the Chancellor. Let's show you what's happening on European bond markets. Of course, we're waiting for gilt markets to open in around half an hour's time. But in the run-up to that, this is what we have on European European bond markets right now, not a huge amount of movement. Kriti?
Absolutely. Let's go to, of course, the main event of the UK, perhaps. Chancellor Rachel Reeves due to unveil the UK's spring economic statement today. She's also expected to slash government spending by billions of pounds in the face of higher borrowing costs and a weakened outlook since her October budget. Bloomberg's Lizzie Burden is over at Westminster for us to walk us through what to expect. Lizzie, start by framing the statement for us. Does a slightly weaker than expected CPI print change anything?
Well, it's certainly a morale boost for Rachel Reeves going into this, Kriti, but it could be that inflation picks up again later in the year. I have to say, the economic backdrop is not what Reeves would have liked at this point in time. She had told us back in July last year that there'd only be one budget a year, and yet, because of the sluggish growth picture in the UK, because of the rising gilt yields, it looks like the headroom that she left herself after the October budget, £9.9 billion, the third smallest in history, may now have been wiped out. So our economists at Bloomberg Economics reckon today she's going to have to reach down the back of the sofa and find £17 billion. And that is why the Conservatives are calling this an emergency budget. It is a lot of difficult political choices she's facing, and the left of her party certainly are very annoyed at the idea that there could be further cuts to come. The left-leading Guardian newspaper here spelling it out for you.
Yes, this is certainly a spring statement that she wanted to be a bit of a non-event, isn't it, Lizzie? She wanted this to pass pretty much unnoticed after the sort of drama, I guess, of the budget. But that's not the case. She is going to have to make some decisions. So where is she going to be able to find that revenue that you referenced?
Yeah, you're absolutely right, Anna, and really Reeves is blaming all of this on global factors, to the annoyance, let me say, of the right-wing papers. Here's the Mail, Reeves kind of pointing the finger to, let's be honest, Donald Trump for the reason that she has to make these difficult decisions today. Where's she going to find this £17 billion? Well, they've already announced £5 billion of welfare cuts. They've already said that they're going to cut the aid budget to fund defence. That's actually a bit of clever accounting, because by Reeves's rules, it counts as investment. So it gives her £2.4 billion, and that therefore leaves £10 billion that she's going to have to find. And we expect it will come from squeezing departmental day-to-day budgets. We'll know how much she'll squeeze them by, but we won't know exactly which departments will feel the pinch until the spending review in June. Now, the trouble is, given these global headwinds, all of the uncertainty, it very well may be that by October 2025, whatever headroom she leaves herself today could again be wiped out. It could be that there has to be an even tougher budget in autumn this year. And when I spoke to Reeves last week, she was not apologetic about her tax rises last year, so maybe that's where they come from. But in any case, as I say, this is politically difficult for a Labour Chancellor to be cutting welfare, cutting aid, previously having cut the pensioners' winter fuel allowance. She's got disquiet among her party and even her cabinet. But having spoken to Reeves many times over the years, before and since she's become Chancellor, I've got to tell you, this is a woman who is scarred by the experience of watching the demise of Liz Truss. This is a Chancellor who does not want to upset the bond vigilantes.
Lizzie, thank you very much. We'll pick up on that now. Lizzie Burden joining us there from Westminster. Let's get a market perspective then on the spring statement and other matters besides. Laurence Mutkin joins us, head of EMEA rate strategy at BMO. Laurence, very nice to have you with us. So not to get into the politics, but in terms of why this has become a bigger deal than the Chancellor wanted it to be, she's going to attempt to blame the global factors. The Trump administration, the new German administration, all of that has put upward pressure on yields. So is she right to do that, or are there domestic drivers as well?
There's certainly a lot going on in the global scene, and there's this big sort of schism now between the outlook for GDP growth in Europe with all its fiscal stimulus and the outlook for GDP growth in the US, which at least over the short term with population reduction are likely to put a lower trajectory on growth there. But the UK is kind of neither of those places. So there's a global upward pressure on yields because of global government borrowing. But in the UK, we kind of have our own issues. And our big issue, of course, is that just as this year was a record for gross gilt issuance. This coming year is going to be another huge year of gross gilt issuance. And what the market's looking for from her is to see just how much more she's going to have to borrow versus finding savings somewhere else. Hopefully not very much.
OK, hopefully not very much. So supply and gilt supply to the market then, a key focus for us as we watch Rachel Reeves and we hear from the other bodies involved with all of the policy making today. I wonder how you reflect on the fiscal rules that she has in place and how important they are, because as Lizzie was saying, some to the left of the Labour Party have started to look at Germany and say, look, there's a country that just ripped up their debt brake and, you know, why can't the UK do something similar? Well, debt levels have something to do with that. But give us, how should she be thinking? How religiously should she attach herself to those fiscal rules?
So I think for bond markets, there's only one fiscal rule, really. For bond markets, the question is, do we trust this government to have a sustainable debt path? And the fiscal rules she specifically chooses to look at are kind of an OK signal for that. You know, but we care, if you like, about, you know, total debt to GDP, and we care about the debt service cost. And if she finds it kind of helpful to frame how you keep those under control in terms of current spending versus current income and so on, that's cool. But I mean, I imagine it would be an enormous shock if she doesn't stay within her fiscal rules, because I think all her measures seem to be created in order to keep within the fiscal rules. So it's kind of, you know, our fiscal rule is, the bond market's fiscal rule is, can we trust you to lend you the money? And I think the answer has to be still, you know, for the UK, easily, yeah.
So these rules are self-imposed, but it would be a risk to get rid of them?
I think it would suggest yeah, it would, for sure.
We had a guest on yesterday, Ian Steely from JP Morgan, who talked about the idea that more issuance ultimately has a dilutive effect on the potential benefits that you see in exposure to a region. He was talking about it in the context of Germany. But I'm curious, when you bring up the issuance point, if that same logic applies to the UK at a time when so many people are exposed to gilt, perhaps more so than they were previously, because of that thought of stability and financial kind of accountability to some extent, or at least plans to be. How do you think about that?
Yeah, well, it is true. In the UK, as we've just been talking about, you know, fiscal responsibility is like a real political issue. And it ain't in most places, right? This is not how electorates choose to elect governments. And it's only in a way because the UK has had an election based yet again around lots and lots of stuff on fiscal responsibility. The UK does look relatively good. But I think, if we think about the global context, global government borrowing is going up. Globally, risk premium is rising. Risk premium are rising in the US and Europe, and of course in the UK. And in a way, there's a crowding effect. So even if you're a relatively good player, if everybody else is borrowing money too, is that good for you, that everybody's in the same boat and you're not as bad as them? Or is it bad for you because everyone's in the same boat? You know, it's
well, what obvious. Side of that is the UK on?
Well, so the UK, we've seen government debt cheapening versus what I think of as the risk-free rate. Kind of at least as much, I would say, as the US. The big mover has been Germany because of this big fiscal switch. I think that's why it's so important that she keep spending and borrowing under control, because this is an environment that isn't going to go away. Government borrowing is accelerating globally, so she's going to have, you know, again, she's going to be competing for funds from investors versus everyone in the world. So the
limit perhaps to the lessons that she should be learning from Germany at this point. Let me ask you about where this leaves the Bank of England, because we see on our Bloomberg terminals that traders are adding to their Bank of England easing bets. They see an 80% chance of a cut in May now. But you, as you sat down, Laurence, drew our attention to the services inflation. And that had escaped my attention earlier. But that is sticky, isn't it? And it's not come down as the market had perhaps anticipated it might.
No, and the reason that that's important is because when the bank thinks about where to put rates, it's obviously looking to the future, to what they like to call the policy relevant horizon, which is like not
2 years,
not
3
now,
years.
exactly, later. When you look at that, they have these various measures of inflation persistence. One of them is to do with, you know, labour market tightness, but you know, another one is services CPI, and you know, the services CPI did not come down at all, still at 5%, which isn't really... It's another warning sign, right, that maybe the persistence of inflation will stay in place. And as Lizzie said, we know we're going to get prints, and as the Bank of England said, north of 3.75% this year. It's going to be quite hard to cut rates in a rising inflation environment when you've also got inflation persistence indicators looking sticky. So the market thought May was a done deal. It changed around a lot the last week to think maybe 50-50. The CPI print today was helpful, but if the budget comes and shows what we saw a little bit of leaking about today, maybe lower growth going forward, that will help them cut in May. But I still think it's quite hard to keep cutting over the course of the next few quarters.
What about quantitative tightening? Could they slow that if they do start to hold or, dare I say, hike down the road? Is the QT, as a liquidity picture, maybe a easier lever to pull?
It's certainly a lever you could pull. I think it's got a massive signalling effect, is the issue. It'd be hard for the Bank of England to change the pace at which they do it or the way they do it, unless it was in response to something, maybe some prudential event.
That's my question, though.
Like,
how quick is that reaction function if you do get more geopolitical volatility? The tariffs come into account, more geopolitical risk out of Ukraine or what have you. Is that a lever they would be pulling more readily?
Look, you're absolutely right. It's a lever to pull, but I think you can only pull it. It's a sequencing question, right? You can only pull it after something bad's happened, not because you think something bad might happen. And I guess that means they can't pull it for now.
Laurence, thank you very much. Thank you for joining us. Really good to get your perspective. A nice primer on the spring statement. You can join us for our special coverage of the Chancellor's spring statement. That's today at 12:15 UK time. Subscribers will also be able to watch on the terminal, and we'll be live streaming our coverage on YouTube as well.
Coming up on the program, we're going to switch focus from the macroeconomics to the micro. A De Beers IPO may finally be on the horizon. Anglo Americans is said to have started talks with the banks on that front. That and your other stocks to watch coming up next. This is Bloomberg.
Welcome back. 7:45 here in London. So 15 minutes until the start of opening trade for European equity markets. And the futures picture looks positive. We factored into European trading to some degree any progress that the United States and Russia had made with regards to Ukraine and specifically the Black Sea in yesterday's session. But US stocks did tick higher towards the end of the trading day, Kriti. And so we wonder whether that pulls us a little bit higher at the start of trade. US futures, though, I should say, are pretty flat this hour. What has caught your eye this morning?
Well, we keep talking about this kind of moves in the markets, how they're digesting perhaps some of the geopolitical headlines that we're seeing from the Middle East to Ukraine. Of course, in the last couple of hours, we've gotten news that there has been a preliminary ceasefire agreement when it comes to the Black Sea. The market reaction off that between Ukraine and Russia has been showing up most closely in the agricultural space. And this is where the chart I really want to show, bringing it all the way back to the start of the war in Ukraine. And these are wheat contracts, mostly actively traded in Chicago futures. And you can see that on the back of that invasion into Ukraine, they really surged. The idea here simply being that Ukraine and Russia together make about 25% of the world's grain supplies. The other pieces of it come from the United States. Those imports and exports still very much functioning. But you can see how since then the pricing has dropped pretty significantly. The changing of this kind of ceasefire agreement in the Black Sea means that exports from Ukraine and Russia can more easily enter the global market. And that's why these wheat futures have actually eased quite significantly. You are seeing some volatility, not just in the commodity space this morning, from the copper story, from the grain story, even from the LNG story a little bit. But the wheat story is really important because it has a direct relationship into the inflationary concepts and the inflation expectations over in the U.S. consumer, but even right here in Europe, where the end product is things like groceries, cereal, bread, etc. And I'm curious how long it'll take for these market moves to show up in that kind of consumption.
Yeah, absolutely. So we watch everything from soft commodities to oil to gas. We'll see whether we see any long-term reassessment of prospects, supply perhaps, for those markets as a result of these limited agreements around the Black Sea. Let's talk about the markets then in 3 minutes. Paul Dobson joins us, Bloomberg Executive Editor for Asia Markets. Paul, I wonder how you reflect on risk appetite as we see it at the moment. We've seen over the last few days global markets perhaps drifting a little bit higher on expectations that maybe the April 2nd tariffs from the US are not as tough as maybe had been feared. Then we see President Trump dialing back on that a little bit. How do you assess prospects as we wait for April the 2nd?
Yeah, good morning, Anna. Well, we're hanging in there at the moment, it looks like, in global equities with a little bit of positivity still seeping into the markets, both in Asia and in Europe today. And I think, you know, the most recent comments that we've got from Trump kind of push you a little bit in both directions, right? On the one hand, he's saying that he doesn't want to see too many exceptions to the tariffs that he's planning to introduce. It would become very messy that way. On the other hand, he's sort of also talking about the idea that there may be some leniency, that he might not go the whole hog. Partly that's probably because it's so difficult to do it and to be able to implement all that, and you don't want to risk aggravating everybody and causing a big sort of tit-for-tat responses as well. One way or the other, though, the market at least feels that whatever we get next week, it's going to be tolerable. So I think that you have that on the equity side. The other thing, of course, to pay attention to is in the metal space. We've got that really big divergence between US copper prices and the London prices because our reporters have learned that the copper tariffs will most likely be introduced a lot sooner than had previously been thought. So that's creating that scramble to get as much of the material over to the US as quickly as possible.
Well, Paul, you talk a little bit about this tariff impact, and of course the market's for sure bracing for it, but you also talk about how they're front-running that impact from a financial market basis. We saw the consumer confidence numbers in the last 24 hours reflect a lot of that same mentality. Walk us through how much of this might just be not just priced into the financial markets, but priced into the consumer thinking and affecting things like inflation expectations.
Yeah, interesting, isn't it? So pretty downbeat outlook from the consumer in the US. You know, worried about the impact that there's going to be on inflation, just worried about that investing climate and that job sort of outlook as well. You know, there's a cloud hanging over everybody at the moment. You hear it from the likes of the Fed's Goolsbee, who was saying overnight, you know, there's a lot of dust in the air. It's that uncertainty factor that's making everybody cautious right now. And so people would really rather there was a resolution one way or the other. And so that's kind of feeding into, you know, the Fed expectations, people sort of dialing back again on the idea that the Fed will cut. Just, you know, kind of like it's going to be steady as she goes as far as that monetary policy support could be, too. Lots of uncertainty, Kriti.
Yeah, a lot of uncertainty there. What about when it comes to the China market, Paul? A couple of banks turning more positive on the China front.
That's right. So the China story continues to roll. We had Morgan Stanley upgrading its forecast again, seeing very positive outlook from Chinese earnings, which are kind of finally bottoming out as in their view. Goldman on the other side is saying China is back, at least on investors' radar. It's not seeing massive flows into China yet, but it is seeing that people are getting more interested in it. And so you have those two factors in there. At the same time, we have the tariffs hanging over people. So we're just waiting for that to clear, and then perhaps it surges back some more.
Certainly something that we are all waiting with bated breath for. Paul Dobson, Bloomberg's executive editor for Asia Markets, joining us this morning. We thank you so much. Let's go from the macro to the micro and get our stocks to watch with Joe Easton. Joe.
Morning, Kriti. So I've got my eye on Prysmian in Italy today. Now, this is a power-generating company that has been exposed to the data centre trend and has seen a bit of a weakness during the past couple of months. But they've announced some M&A over in the US worth around $950 million as they look to expand their data centre capability. We can see that dip down in the stock, but they have also given some strong guidance as well at their capital markets day. Expect this one to be a bit of a mover at the open of trading in Italy this morning. Then in terms of miners, Anglo American said to be pushing ahead with the spin-off or IPO of their De Beers diamond unit. That's according to Bloomberg sources last night, so that could potentially be one in focus in London. And of course, on the mining front, we've also got the news of Trump potentially bringing forward those tariffs on copper. That could come sooner than expected, according to people familiar with the matter. So we're going to be keeping an eye on all the London names, Anglo, Glencore, Rio and Antofagasta in particular. And there's the jump that we've seen in US copper futures overnight. So potentially that is just going to be a broad sentiment boost for the mining and metal stocks this morning across Europe. So keep an eye on those. Then in terms of your frozen food, ready meals and salads that are sold out of Tesco's, we got an update from the potential merger between Greencore and Bakkavor. I've completely mispronounced that, Bakkavor. Excuse me, I knew I'd get that one right eventually. Now, that is a deal that could potentially see the bid price come up. Greencore has made 2 offers for the company already, and they are looking to potentially increase that, according to Bloomberg sources. So that could potentially add to the upside we've seen in that stock. Keep an eye on Greencore and Bakkavor in London today. Then on ratings, Goldman has a massive note on technology and media. Couple of upgrades that are picked out. Prosus and Publicis, both buys at Goldman. Total Energies in the oil sector is raised to buy at Citi. And Ocado, an overweight at JP Morgan after a rough run. That one could also be a mover in London this morning.
OK, Joe, thank you very much. Our equities reporter, Joe Easton. Kriti, sitting here on, what is it, the 26th of March, I find myself wondering, are we nearly there yet when it comes to the tariff so-called Liberation Day from President Trump's perspective? It seems like so much is hanging over that day, and at least to see the detail on the page of what those tariffs would look like, then we know what the rest of the world has to retaliate against if they choose to do so.
Well, absolutely. And Paul kind of mentioned this as well. You're already seeing it some priced in the commodity market, but this is where I think a day like today is great, because in 6 minutes' time, or I should say 5 minutes' time, we're going to get the opening trades across Europe and see how much of that is actually being taken seriously, as opposed to perhaps being on the back foot, waiting for them to actually be implemented the way that, say, the markets were interpreting auto tariffs or pharma tariffs, for example. Do they view copper tariffs and the development, by the way, in the Black Sea in the same way?
Yes, and we got that Black Sea news just into the end of the session yesterday, didn't we? So we've had a little bit of time to deal with that, but the copper news, we'll see how that one works its way through. European equity market open then, that is coming up in just a few minutes' time. The US futures picture looks pretty flat this hour, but we could see some upside before we get to US trading. We'll be back shortly with the European market open. This is Bloomberg. Welcome back. This is the opening trade. A few minutes then until that opening trade across European equity markets. Let's take stock of where we've come from in the past 24 hours. This is the picture for European stocks yesterday, making those gains early in the session as a result of expectations that April 2nd's tariffs might not be as tough as had been previously thought. And that helped us to make some gains early on. We lost a little bit of momentum. The market was dealing with a couple of factors. One was around the weakness in the US consumer yesterday, although the market chose to look through that a little bit. We saw that as a bit of a headwind, perhaps, to at least market thinking. We also saw the latest news out of the Black Sea and that agreement around the US and Russia and what they've managed to agree there. Some details still a little unclear as to what exactly has been agreed on the sanctions side in particular. But take that for what it is. The market dealing with all of that, and it adds up to a futures picture for Europe that looks as if we'll be going a little bit firmer at the start of trade. So a lot of those news items I mentioned we've priced in already, but does look as if we've got some room for some upside this morning. We've seen a bit of weakness then, Kriti, coming through in the pound as a result of that CPI print. Sometimes that throws the FTSE in a different direction to the others, but that's not the case this morning. We are expecting all of these markets to head a little bit higher at the start of trade.
Absolutely. Certainly something we're going to be keeping a very, very close eye on. How much of that is driven by the geopolitical news, though, as well? And in terms of our stocks to watch, some of the key sectors we've got our eye on, it feels like a commodities-driven day. I'll start off with Total Energies because they just got a big upgrade from Citi as well. So we'll see if that actually shows up in terms of the big moves there. We also have an interview with the Shell CEO we're going to be talking about later. The miners are going to be crucial in terms of the copper tariffs, how much of that is actually priced in. And then, as Anna mentioned, that geopolitical risk and perhaps positive peace dividend coming in the Black Sea showing up in those shipping stocks.
Yeah, we continue to watch any read across from that Black Sea arrangement, the Black Sea details as they become clearer and clearer. Perhaps they will have an impact. Let's have a look at where we open up these markets then. We're waiting for later today to hear from the UK Chancellor, Kriti. So from a UK perspective, perhaps that's something that is a big calendar item, at least, that we will focus in on. The spring statement coming later from the Chancellor here in the UK. But other markets around Europe not waiting for that kind of news flow. And the Stock 600 is pretty flat. The FTSE 100 up by 0.2%. So we're seeing a little bit of that modest positivity coming through this morning. We'll keep an eye, as you said, on those mining names, on anything to do with the commodity-related trade. Yesterday, we saw some tentative movement in some of the fertilizer stocks, some of the soft commodities, some of the oil and gas news flow surrounding the Black Sea. So it's starting to get through into the market thinking, but we'll see if there's any more to run on that particular agenda. The DAX is up by 0.4%. The CAC 40's up by 0.2. The IBEX, though, pretty flat this morning. Kriti, do you see anything more interesting beneath the hood? A sort of modestly positive positive start to trade this morning?
Modestly positive is absolutely the right way to put it in terms of some of these moves. A lot of this is driven by a lot of the kind of energy space that we were talking about and the commodity space as well. A mixed bag when you look at the sector picture, though. On the back foot is your healthcare, telecom, travel, and leisure. But your outperformer this morning from an index contribution perspective, Shell is at the top of the list. And a lot of that has to do with the strategy that they've been talking to Bloomberg about, as well as some of the other media outlets as well. Tech is also back on the front foot. Schneider Electric, ASML. So these are two sectors that don't often move together, tech and energy, and yet that's what's driving the trade this morning.
Yes, and basic resources does seem to be another sector that's providing some upside this morning. The best performing sector this morning for European equity markets, up by 0.7%. Anglo-American is one of those. Glencore, Rio Tinto also higher. And I think Joe Easton was telling us a little bit about some of the sector news flow there. Let's have a quick look at what's going on with gilt markets, because we're seeing gilts gaining after that UK CPI print. It came in weaker than had been anticipated. Does it make it easier for the Bank of England to cut rates? The view of our guest was not necessarily, because inflation will pick up again later on in the year. And also he was flagging the stickiness of services inflation. But for what it's worth, we do see those yields moving this morning down around, 3-4 basis points on UK gilts this morning.
Absolutely, and we're going to see how much of that shakes out or how much of that changes, of course, as we get closer and closer to that spring statement off the back of the CPI numbers. Let's bring in a markets guest here who, of course, can have a little bit more analysis on how to interpret the world at play. Obi Ejikeme, fund manager over at the global equities team at Carmignac, joins us around the table. It'll be a pleasure to have you on this program. We keep kind of waiting to see how some of these geopolitical stories, the tariff stories, are going to shape the equity market. What is the smartest thing to do right now? To sit on the sidelines and wait for the impact, or to trade it ahead of time?
Morning again. I think sitting on the sidelines is a risky strategy. I mean, there's as a result of what's happened that we've seen this year already, there's been a lot of stocks that actually have very, very little to do with the geopolitics that have had quite severe corrections for various different reasons, which we can come on to. So I think sitting on the sidelines will mean that you'll miss out on those opportunities. Geopolitics has been an issue for many, many years. There's always something. I remember in 2023, 2022, there was always something that you need to be worried about. Now, as an equity investor, I think you need to look through those and stay invested and look for the opportunities in stocks that will be able to weather the storm and survive and be here in the years to come.
It kind of sounds like there's a hedging strategy at play. Where's the best place in the market to do that?
Well, I think in terms of hedging, I think just look for the areas of the market that you like over the long term. I mean, some of the names that we've been adding to recently in some sectors which really, like I said, are not really linked to it. In the technology space, for example, especially in some of the mega cap US space, where really the geopolitical noise is not going to have a significant disruption. I mean, look for areas where there's been stocks that have been hit by sentiment just deteriorating. So, for us right now, we're looking in the US in particular. I know the stories about Europe, and we all want to look for opportunities in Europe. But in the US, you've had a sizable correction in some of the long-term winners, and that's part of the market that I think looks quite interesting at the moment.
Yeah, Obi, good morning. It's interesting. You've been adding to your positions in some of those big US tech names. So the tech names themselves and some of the AI proxies. I suppose it's interesting to hear your arguments as to why you do that, because if you still believe in them, then why not? But some of the fears have been around rivalry from Chinese startups, for example, DeepSeek, and other fears have been around maybe inflated expectations of just how much capex some of these big US tech names are going to do, and therefore how much how much growth they're going to see in AI. So why do you have so much more confidence maybe than some in the market around those tech themes?
Well, I think, first of all, we're long-term investors. And so if you're thinking over 3 to 5 years, then it's very rare that you get dips in great businesses that you're investing in for the long term. The second part is just the valuations of some of these stocks now. We were worried at the beginning of the year that they were expensive, and I think there was a valid argument for that. They came off the back of a phenomenal growth rate, 35% earnings growth last year, and expectations were dropping to 25% for this year for those type of companies. Now, that's a big drop, and so therefore the valuations needed to come down. And I think we just had that. So if you had a valuation reset, now we start to grow from a new base, and that's an opportunity to buy in as an investor. And then I just think that broadly sentiment, if you look at retail investor sentiment, we have a great index that we look at, which is the American Association of Individual Investors. And it tells you whether they're bullish or they're bearish. And, we hit lows in the last 2 or 3 weeks that we've not seen since 2022, which was a phenomenal opportunity to buy back into these stocks. So sentiment plus the long-term thinking in these stocks and valuations which are now not as expensive as they were at the start of the year creates an interesting opportunity.
What do you make, Obi, what do you make of the US consumer weakness that we've seen, certainly in the survey data, not necessarily in the hard data, but in survey data? This seemed to be something that the market managed to look through yesterday. But for some people, this is cause for concern, a 12-year low on consumer expectations in the States. Now, I'm not suggesting that that should influence the amount of data centres that some of these big hyperscalers build. There isn't that connection there necessarily. But what kind of downweight can this consumer spending story apply to the US tech sector, or is it going to be immune?
I think it's going to be relatively immune, but I think it's important just to make a broader assessment of what's been going on. You know, if you take the US and look at profits growth over the last couple of years, it's been pretty anemic. So if you take out the best companies, what I think people would refer to as the Magnificent Seven, and basically there's been almost no growth last year and almost no growth in terms of earnings the year before. And so that environment it puts you at risk if things start to go wrong. And I think the consumer is reflecting that. No growth, therefore, if things start to go wrong, on the margin, sentiment deteriorates a lot faster. But actually, if you add all these things together, very weak consumer sentiment, very weak retail sentiment, very significant geopolitical uncertainty and policy uncertainty in the US. People are very, very fearful today. And when you have that amount of fear, as an investor, you have to start to think about the contrarian side of it. It's not to be gung-ho and be too risky, but actually, on the margin, you don't get these opportunities very often where people are so negative that the net new move forward was probably going to be more positive than that.
You use the word margin. I'm going to put it in a different context, though. Talk to us a little bit about pricing power here. If we're talking about this era of caution, we saw it in the data as well. Anna mentioned the consumer confidence numbers in the States as well. Does that limit companies' pricing power, and does that limit some of the kind of costs that they can pass on, which in turn limits the margins, the EPS, et cetera? Is that what you're seeing?
Yeah, Kriti, but that's not new. That's been going on for some time, and that's where we invented the phrase the Magnificent Seven in the first place. They are the very few companies, and we don't invest in all of them, but we have significant exposure to some of them. But that's where you have companies that have been able to grow their revenues and their top line by over 15% on an annual basis. That's very, very difficult to do, and that's where most companies are struggling. Difficult to grow their revenues, and as a result, difficult to grow their profits. And so that's not a new story, and I think that's going to be a continuing trend, especially as we start to deal with the impact of tariffs and so on. So, yeah, it's a bit more of the same to me than it has been anything different.
And Obi, where are you looking in Europe? So that's your US enthusiasm, and we understand that's from a long-term perspective. Where does that same long-term perspective take you in Europe then? Because we've seen this, according to Mario Draghi, game-changing reset in policy from Germany. So what does that add up to? What opportunity does that add up to for you?
Well, I think in Europe it's now becoming more challenging because, you know, first of all, we had a significant rally in European stocks year to date on the hope that we're going to see some of the stimulus, and I'm sure some of it will come through. And so when you hit the valuations that we're now seeing on Europe, if you take the stocks, Euro Stocks 50, for example, it's now trading at the highest valuation that it has done in the last 10 years, if you strip out that sort of COVID era, which was a bit of an exception. So you're not buying into a market that's particularly cheap. So I think that the next trade for Europe is to buy into stocks which have the earnings story and the earnings momentum story. And that's where we still like the long-term compounding. Our fund is called the Carmignac Global Equity Compounders. Mm-hmm. So we like the compounding, snappy. We like the compounding stories. So we like the names like Novo Nordisk. Again, another stock which has been had a bit of a derating on growth fears, but we like it over the long term. Schneider Electric. So there are names, but we tend to prefer to be in the spaces where we can have a good, decent 3 to 5 year story, as opposed to trying to chase the shorter term.
Yeah, so Europe's
stories.
not cheap anymore. This is new.
This is new, but so much of that, it feels like, when you look at it from a valuation perspective, has been driven by buybacks, dividends, kind of this capital return, which the critics of that argument would say has inflated these valuations. Where do you stand on that?
Look, I think in Europe, I think it's just a case of a re-rating story, and that's really been it. I mean, when you have everybody positioned in the US at the start of the year, we were on the back of this sort of US exceptionalism, and you've had the money flow into Europe, it's pushed the valuation of the market up, and earnings really haven't gone up. And that's where we're going to have a test over the next 2 to 3 quarters, is whether or not the companies can deliver on now the higher multiple that Europe's trading on. So I think it's more of just the optimism in Europe has seen a big flow of money into it, rather than anything specific from a fundamental perspective.
I mean, the global rotation has been, I think it's it's fair to say historic at this point. Opie Ejikeme, fund manager over at the global equities team at Carmignac, giving us his analysis this morning. Let's get a quick check on the core six here. Of course, the biggest heavyweights that may or may not be moving the trade. A lot of it is focused on the tech space. Take a look at ASML, Schneider Electric. They are your two outperformers this morning, your two biggest index contributors to the stock 600. Schneider Electric really taking the cake the last couple of days, moving the entire French market as well, higher by 0.6%. But on the back foot, and I feel like I say this quite often, Novo Nordisk down by about 1.4%, and LVMH as well, perhaps paring back, at least on the LVMH front, the outperformance in yesterday's session. That is your core six. Let's get a check some of the other individual stocks on the move with Joe Easton. Joe.
So we're seeing a big move in CD Projekt over in Poland today. This is the games maker over in Warsaw, hit after another delay to its Witcher game that has been flagged by analysts recently, saying they were worried that could see a delay. And that's what we're seeing, more delays in terms of a few more months until that hits the shelves, and that is hitting the stock this morning. So we're down 8%. That's the worst performer on the stock 600 for CD Projekt. Then in terms of Prysmian, that one looked a little bit stronger. The company doing some M&A over in the US, expanding its footprint as it builds out more energy supplies for data centers, all tied to the AI trend. Of course, that one up 2.3% in Italy, and some positive trading numbers coming out of their CMD as well. So a good one for the Italian sector. Then in terms of your ready meals, frozen lasagnas, we've got M&A in that sector, of course. Bakkavor getting that takeover bid potentially going to be increased in terms of the offer price coming from Greencore. Bakkavor supplies to Tesco, so up 6%, a decent move. That one has rallied over the past few weeks on the speculation of that deal coming through. Then a big decliner in the UK at the open was Vistry. We're down 7.5% on that one. Now, weak trading update out of the UK home builder. Once again, they've had a couple of profit warnings, and also we've had that UK inflation number as well, of course, and as well Rachel Reeves giving her statement later today. A lot of focus on the UK market and particularly home builders. If we do see any more movement in the gilt yields this morning, do keep an eye on home builders. But Vistry, the worst performer, given a weak trading update from the company. Now, take a look at Ocado, up 12% this morning on an upgrade from JP Morgan. They say they are about to see the turn in the tide for Ocado on both their retail sales and also their sales of robotic warehouses to other grocers. That's going to potentially start boosting the company, according to JPM. They go overweight in the stock. I can't believe that price up 11% at the moment following the JP Morgan upgrade. Really powerful in terms of that rating change this morning. And another one I liked was Intesa Sanpaolo, upgraded at Exane BNP Paribas. This is because of the Italian banking M&A, and they think Intesa is going to be the next one to benefit from that. UniCredit is their top pick, but they also like Intesa. Comes up and the stock is rising 1% as it goes to outperform Intesa Sanpaolo, gaining in Italy this morning.
Joe Easton from our equities team walking us through some of those early movers. We thank you so much. And, of course, it is still a change in daylight savings, which means the U.S. pre-market has also opened. 3 stocks you definitely want to keep on your radar, and I want to point out to you. Let's start off with Tesla here. In the pre-market, down about 1.8%. It saw a big move to the upside to the tune of over 20% in the last couple of days, also paring back its massive drop year to date as well. It looks like it is back in the red this morning, down about 1.7%. NVIDIA as well, seeing a drop in their China sales. That perhaps weighing on the stock in the pre-market, down by about 0.7%. But the copper story lives on. It is boosting Freeport-McMoRan, seeing the most volume this morning in the U.S. session to the tune of 1.4%.
OK, coming up on the programme, we focus in on commodities. Shell bets big on natural gas. We'll bring you an interview with the energy company's CEO. That is coming up next. This is Bloomberg.
Welcome back to the opening trade. We're 18 minutes into today's session. Seeing a lot of those opening gains pared back when it comes to the European session. I'm looking at the Eurostoxx 50 down about 0.2%, broadening out to the 600, also down by about the same margin. A similar story across the board. Some slight outperformance in the FTSE 100. They could be responding to the positivity you're seeing in the oil and mining space. But Anna, a complete turnaround just 20 minutes into the session.
Yes, indeed. Let's talk about the commodity markets, because there we're seeing some volatility as well. Shell CEO Wael Sawan has warned investors that pursuing major deals could serve as a distraction. He also spoke to Bloomberg about the company's move to put LNG at the heart of its 10-year strategy.
We're very proud of where we are today. Today in the Capital Markets Day, we took a pause and reflected on the journey we've been on over the past couple of years. And the key message was one of trying to instill confidence. Here's a company that has delivered what it said it was going to do and actually over-delivered in certain areas. And beyond that, as you rightly pointed out, we've also today laid out a vision out to 2035 that has LNG at the heart of it. We believe LNG is going to be a critical part of the energy system, and we want to be the leading player in LNG. But our story also has lots of richness around wanting to sustain material liquids production and being the most competitive and the most focused energy marketer and energy trader in the world. And so a holistic story that I think we're very proud to be able to say is well on track.
Are you worried at all about a potential looming LNG supply glut and kind of betting really big on this for the next 10 years at a time where there's just too much supply coming online?
Look, in my job, I have to look at 20 years. And what I see when I do that is up to 2040, we see a potential 60% increase in overall LNG demand. We have a diversified portfolio, both of production sources as well as demand options. And we are very much looking to leverage that global diversity of production and customer contracts to be able to create value. Importantly, our LNG portfolio is heavily linked to long-term contracts that are tied to Brent, which means we have a lot of resilience. And so we can ride out the inevitable cycles in this business while making sure that the underlying cash flow continues to come from this business.
So what should investors look for in terms of the capacity increase on your LNG output?
Very much what we outlined today, which is 4 to 5% per year, so indeed the 20 to 30% by 2030, and that's just to 2030. We see more running room beyond that. We have projects that we can evolve over and above that. But what's unique around our LNG business is not just the production piece. We are actually also selling roughly the equivalent amount, not just of what we produce, but also another equivalent amount to that, because we're also one of the largest optimizers of LNG in the market. And so in any year, we're selling around 60 million tons of LNG, which is significant. And so we are trying to continue to build up our portfolio to really have that diversity and to be able to make sure that we can continue to essentially stay in the 15 to 20% of the overall LNG market is what we represent.
That was the Shell CEO, Wael Sawan, speaking to the Bloomberg team, talking about the company's LNG push. We will circle back to that story in just a moment, because let's focus on other matters to do with commodities. Oil, wheat and corn futures have been on the move after Russia and Ukraine agreed to a ceasefire in the Black Sea in talks alongside the United States. Some of the key details perhaps missing, but Black Sea ports are major hubs for grain and fertilizer exports. Washington says the agreements will also ensure Russian access to these goods. Joining us now, Bloomberg Senior Executive Editor for Energy and Commodities, Will Kennedy. Will, good morning to you. There's a lot in the mix today when it comes to the commodities space. Let's start with some of these soft commodities and how they might move on the back of the news lines we've had on Russia, Ukraine. It did seem as if the Russians are saying we will agree to this Black Sea ceasefire as long as we get sanctions lifted on SWIFT, for example. The US pledging to help them in some ways with some of that. But does that leave things clear for commodities traders about what this means for commodities or not?
No, I think things are quite unclear, and you see that, and there hasn't been a massive price reaction. The situation in the Black Sea has been volatile over the course of the war, and there was a time when it had really constricted exports of grain from Ukraine in particular. Things are flowing. I think if you got this ceasefire and it did prove to be sustained, what it would do would reduce costs markedly for those exports, i.e. insuring those ships, the cost of hiring those ships would come down, and it would make trade easier. It wouldn't mean a huge amount of flow into the market, because most Russian and a lot of Ukrainian grain has been finding its way into global markets.
Talk to us a little bit about the impact perhaps on the shipping costs then when it comes to the Black Sea. If it doesn't show up directly in the commodity market, does it show up in the transport around the commodity market?
Yeah, I think that's where the biggest impact would be, because right now a lot of ship owners don't want to go into the Black Sea. It's still risky. There were some incidents around mines earlier on in the war, and they still have to pay very high insurance costs. So it would definitely bring down shipping costs in the region, which ultimately would feed through into the final price that people pay for wheat exports from Ukraine and Russia, and it is the most important source of wheat exports to the global market.
OK, so that's the Ukraine story. As much as we know right now, wait for further details. We're also waiting for any detail around tariffs as it pertains to commodities. And copper seems to be the thing that has caught everybody's attention. It's a real hot mess, was the words on the Markets Live blog earlier on, because of this big gap that's opening up now between US pricing of copper and the LME price. Where is this heading then, Will?
Yeah, I mean, this is a market where you've seen real dislocation as traders are having to speculate about the tariff to come. I think that President Trump has made clear that following on from tariffs which are in place on aluminium and steel imports, he does want to see those tariffs on copper. The really important question for the market is when. We've seen traders move many, many thousands of tons of copper from outside the US into the US market, and then that's produced this spread, as you described, between US copper prices, which are trading at a record, and London prices, which are significant discounts. So you've got this transatlantic arbitrage. The real question now is if those sanctions come in much quicker than people have expected, will some of that metal be stranded? Will traders be faced with metal on the water that hasn't made it to the US in time? So that's why people are describing a messy situation, and the all-important question is exactly when those tariffs would come in. Our reporting says it might be sooner rather than later.
Does it have anything to do in terms of the ripple effects here? I mean, I thought it was interesting that he targeted copper tariffs, given that Chile is the biggest producer and China's the biggest consumer. So how does this feed back into perhaps his broader agenda?
Well, I think it's all about reindustrializing in the US. There are copper projects in the US. There's a big mine in Arizona that's taken many years to get going, and I think he would love to see built, and it would give some impetus, presumably, to copper production inside the United States. He seems very focused on this idea of strategic minerals, critical minerals, no matter how you want to describe it. And I think he would like to have more copper produced in the United States. But I think there are some problems in the policy, as you point out, Kriti.
Well, we just heard from the Shell CEO talking about how pursuing any major deals would be a risk, a bit of a distraction right now. I mean, this is a business that knows something about major deals. If you cast your minds back, less than 10 years, I think, and there was a huge deal that was a real big bet on gas. So, I mean, they've done big deals already.
And in fact, that big deal laid the foundations for the strategy that we heard Weil describe there, which was LNG. That LNG business was built partly on the successful acquisition of BG, another UK company, about 10 years ago, as you say. Of course, we asked the question because of BP. BP is not the favourite company among investors. It's had this strategy reset under pressure from the activist Elliott. And, you know, investors aren't loving what they see there. So that's led to some inevitable speculation that we could create Shell BP, this giant UK oil major. Who knows? I'm not going to speculate on that, but clearly these are the decisions that Wael Sawan is having to make. If there's a criticism to make of his strategy, which was warmly received, it's that there isn't that much investment, that much growth. So where's that going to come from?
Certainly something we're going to be keeping an eye on. Bloomberg's Will Kennedy walking us through the various commodity stories that are in the market this morning. Coming up next, we're going to switch focus from the energy sector to the banking sector. That conversation next. This is Bloomberg. This is the opening trade. We're 30 minutes into the European session, seeing red on the screen in most geographies, perhaps taking a little bit of breather, perhaps a little bit of caution. The Stock 600 down about 0.3%. I'm looking at a CAC 40 that is also down by about the same margin. The FTSE 100, the sole outperformer, but not by much, only higher by 0.1%. The mining story, perhaps working in its favor. Let's shift our focus, though, a little bit to the banking sector as well. Sources say UBS is offering to limit the future size of the investment bank and hold more capital in a bid to ward off stricter regulations. It's the latest move in the long-running back and forth between the banking giant and Swiss regulator FINMA. Joining us now for more on this, Bloomberg European finance and regulation reporter Nicholas Comfort joins the program. Nick, we know this has been an ongoing conversation in terms of capital requirements across Europe, not just in Switzerland, largely when we're seeing the United States deregulate, when we're seeing the United States capital requirements come down as well. How much of an impact does this make in terms of UBS and I'll say broader Europe's competitiveness with the U.S. based solely on this conversation?
Yeah, I think so. Clearly, this is a Swiss story, Swiss exceptionalism in this case, because, I mean, as you see other jurisdictions sort of speaking about deregulation or in the European Union simplification, the Swiss are going another way. They're ramping up capital requirements on UBS. It's got some investors worried, that's true, and the lobbying is pretty intense in Switzerland. We have UBS saying that they would be thinking about a move to a different jurisdiction, or at least sort of intimating that to us in the press. And so that's really a question of, in this hot phase of these capital requirements which are being debated, which we expect to be coming to Swiss Parliament in May, we're really in the phase where the knives are out, and UBS is really trying to push back as hard as it can, arguing that it would indeed become less competitive versus other banks in other jurisdictions.
Yes, and Nick, part of that argument then, or part of the concession they're prepared to make to avoid some wider controls perhaps from FINMA, according to our reporting this morning, talking to people familiar with the matter then, UBS executives have suggested that a permanent cap on the size of the investment bank could actually be written into Swiss law. This sounds like quite an exceptional move. Is that going to move the conversation on, do we think, in Switzerland?
It could well. I mean, I think sort of we've got these two positions which are really diametrically opposed. The regulator on the one side willing to make very little movement in terms of its plans, only willing to phase it in slowly, the impact of the capital requirements. And then UBS coming out with something which, I got to say, to me, sounds pretty similar to what they have been communicating to investors already, saying sort of, well, like our investment bank is only one part of our business, and there's a limit on the size of it. This limit would be more rigorous than the one which we've seen previously. But honestly, it doesn't seem like neither the regulator nor UBS in this particular piece of news has really made a big step here in terms of willing to compromise. So for me, these are still the opening skirmishes between them, and we probably will see some kind of a compromise, but it's going to need people to really jump over their shadows, as you say in German, to try and find something which is more acceptable to the other side.
German always has some good ways of some more words. We need more words in English. Jumping over shadows. We can introduce that one. Bloomberg's Nick Comfort. Thank you very much for the update there on UBS. Let's stick with the UBS theme and broaden the conversation to the wider banking sector. Jackie Inniker joins us, CIO at Spring Investments. Jackie, nice to speak to you. So it seems as if, so Nick's view there, we're still in this sort of opening stages of a standoff between UBS and the regulator. This latest suggestion from UBS that they would actually submit to having the size of their investment bank written into Swiss law, which seems quite incredible. I mean, where do you see this decision-making around UBS heading? Because they've threatened to leave. Some say that's not realistic.
I think we've got years to go on it. I mean, if you look at what's going through Parliament, that's going to be in a couple of years. There'll be a referendum. I'm Swiss, so I'm going to vote on it. But in May, so we've got proposals in May coming, but they're on the small part of the capital requirements. They're on the DTAs. They're on the software intangibles. The really juicy parts are going to come not before 2027. There's going to be a proposal, and then probably 2028 is probably going to be a referendum. So it's a long way we've got, and there's no incentive for UBS management to underplay, how important this is. So I think, we're going to get more and more of this as the months go by.
So UBS will keep threatening to leave to try and get a better favourable environment, perhaps. Yeah. But I mean, and the regulatory environment globally perhaps plays to their favour, because they can point to the United States and say, look, America is regulating less, not more.
Yeah, they can. And when you look at UBS in terms of their equity ratios now, they're pretty much in the pack. They're not lower than, their big peers. So I think it's more about how you allocate that capital. The big story is about the treatment of capital for the foreign subsidiaries. And that's going to be an art, not a science. And when you think about double leverage and what the big banks do with that, I think there's lots of ways that this can go. But I think it's going to take a couple of years. That's the thing.
So there's deregulation and then there's simplification. Jackie, I just want to play you a piece of sound that we had in an interview with the Bank of Spain governor, who also serves in a banking supervisory authority. I asked him this very question on whether or not these banking capital rules are necessary. Take a listen to what he had to say.
Simplification doesn't mean by any means lower capital or deregulation.
But even to delay the Basel III requirements to compete with the U.S.?
I think Europe should not do that. I think Europe should stick to the path and that we have decided ourselves, and we should not be pushed by the decision in other jurisdictions, by no means.
So an ECB policymaker, they're making the argument that deregulation is not the answer, simplification of the rules, that these capital requirements is not going to hinder its competitive nature. But this word simplification has come up quite a bit, from banking CEOs to policymakers. What does that actually mean?
Well, I think it's what the UK is doing now. Since Brexit, they have, I think they used the phrase removing unnecessary hurdles, simplification, really. So I think that's a good thing, simplification, maybe for the smaller banks, which is exactly what the UK is looking at. But honestly, you mentioned deregulation. I'm not sure we're going to get deregulation. I think we're going to get a stop in further regulation in the US. And is that a good thing for the big banks? Yeah, I think it's okay. But they're already very well regulated, just different from Europe. We cannot get a single level playing field. It's impossible. We do it differently, Europe and the US, but both work. I think where the problem for me comes, and I focus on European bank debt, is for the smaller US banks. The big US banks are very well regulated, but in Europe we apply our regulations really down to some of the smallest banks. In the US they don't do that. I think that's where regulation is needed, but from our perspective, I'm not too worried about that. We focus on the debt of the larger banks.
And we kind of saw that with the SVB kind of regional banking crisis as well. That was a great example. But one of the big questions around simplification, specifically for the banking finance, has been in the context of defense spending, right? This massive 500 billion euros that have been unleashed in the markets. There's questions around the red tape in terms of putting up collateral for some of the banks for the defense spending. How easy is it for the European banks to participate in this fiscal boom?
My view would be it's very easy. I think there'll be ways to do it. You have to have banks to move the economy forward. You have to create ways to allow them to do their job, which is to support the economy and support the economy's growth. So, if there are hurdles here, they will be simplified. And again, you've kind of seen that in the UK already. It's been happening fairly slowly, but I think the UK clearly has more leeway. There's not, 26, 27 countries who have to, agree on this.
Jackie, you say you focus on European banks, specifically their debt, but European banks. So let's look to the European space. I'm looking at, actually, on the stock side of things, European banks are the best performing sector year to date in Europe, so up by 27-28%. And part of that is to do with that fiscal boom and what that does to Europe. Part of that is, well, maybe that also means that we don't get rate cuts in Europe. What are you assuming about that rate cut environment in Europe?
Yeah, on the rate cuts, obviously it's more in question, but, our view at Spring is that, we will still see rate cuts here. I think that can be both good and bad for European banks. Good deposits, the cost of deposit goes down, fee income gets bigger. I think one key impact as well is that for rate-sensitive banking sectors like Italy, you'll see them look to, deploy capital elsewhere, maybe in M&A, maybe more share buybacks, because they need to boost that EPS to keep boosting it, let's say. And so for them, for the rate-sensitive banks, continued rate cuts are actually, relatively negative, but there's other stuff that they're forced into doing.
What I find fascinating is the biggest banks that are engaging in M&A are also the ones that have the biggest buybacks. So you see it in UniCredit, you see it in BBVA, you see it in others as well that have that kind of M&A inclination. Do they run out of money at some point?
Well, no, because the supervisors won't let them. That's the thing. You see, if you're UniCredit and you want to do, I'll throw it out there, like a 10 billion share buyback, they've got nearly 16% equity ratio.
Yeah.
What's okay is 12 or 13. I'm a credit analyst, even I'm saying that, a lower equity ratio is fine. So if you're UniCredit and you want to get to 12% immediately, which is not their target, you go to the ECB, you say, can I do a 10 billion buyback? You've seen what's happening in Switzerland. They're not going to say, yeah, go on, go for it, do that next month and let's see how it goes. They're going to say, do it slowly, do it over time. They're generating so many profits, they almost can't catch up with themselves.
Yeah.
But one other thing they can do, apart from share buybacks, is acquisitions. And obviously that's what you're seeing happening.
Well, it's just fascinating because it usually happens one or the other. You don't see them at the same time necessarily, but this is a different environment. Exactly. Jackie Ejikeme, pleasure to have you on the program, CIO of Spring Investments. We thank you so much. Coming up on the program, we're going to go right back to, I think, the main agenda topic of the day, which is, of course, what's happening right here in the UK. Chancellor Rachel Reeves expected to slash spending when she delivers her spring statement later today. We're live at Westminster next with the Treasury Select Committee Chair and Labour MP Meg Hillier. This is Bloomberg.
The overall message needs to be a bit of a reset, frankly. The government didn't get off to the best of starts, although it had a lot of goodwill, and it inherited problems. But the result is at summits like this, on the other side of the world, there's quite a negative sentiment about the UK, and that needs to be changed.
Trying to reset the conversation then globally, former UK Chancellor George Osborne speaking to Bloomberg on the sidelines of the HSBC Global Investment Summit. I mean, Chancellor, a very long time ago now, you know, big in the museum world is where he resides. We've had UK data out this morning at Kriti. We got the CPI number. It came in soft. The pound dropped. But does that mean anything for the Bank of England's ability to cut rates? We got some interesting perspective on that from Laurence Mutkin, saying, just as Lizzie did, that we are going to see a pickup in inflation later on in the year. So maybe that means the Bank of England can't cut rates quite so readily. And also flagging this services CPI number that came in at 5%. And that has been something that the Bank of England has sort of attached its focus to when it comes to just how sticky inflation is in the UK.
And they're now pricing in an 80% chance of a cut in May, something we spoke to Laurence Mutkin about, and saying the likelihood of that is still up in the air when it comes to that.
Yeah. Dan Hansen joins us, Bloomberg's chief UK economist. He can weigh in on this inflation point. Before we get to the spring statement then, Dan, on the inflation side of things, yes, we were having this debate earlier, you know, weaker inflation. Well, does that mean the Bank of England is more likely to cut rates? The market move in that direction, but it's not a 100% chance for May, is it? And yet we still have this sticky services print on inflation.
Yeah.
What were your takeaways?
Yeah, I mean, the market is focused squarely on the headline surprise. Everyone was expecting 3. We got 2.8. If you dig beneath the surface, though, I think you're absolutely right to highlight the point about services inflation. And if you go back to the minutes of the meeting last week, the Bank of England's meeting last week, they were highlighting this idea about sticky underlying inflation, and by that they mean sticky services inflation. And if you look at the data today, it's sticky. You know, it's not moving down. And I think they probably will cut in May, but our forecast is for a quarterly path of cuts. I think in the second half of the year, that's becoming we're a little bit worried about that now, that they might pause.
Because inflation might go up again.
First of all, because headline inflation is going to go up. That has implications for inflation expectations. And second of all, because of this services inflation point, it's sticky.
So what can Rachel Reeves say today to make everyone feel better?
I think she's going to say a few things. So, first of all...
Is that where the bar is, by the way?
Yeah, I think comfort is Go ahead, Dan.
No, thanks. So the first thing is, and the key message is the world has changed, and we all know that. And that's going to be the sort of how she's going to frame, if you like, what she's going to announce.
And that means higher rates, just to turn that into financial lingo. Yes, the world's changed, but...
Yeah, it means higher interest rates, it means higher defence spending.
Yes, OK.
It's two things, both of which obviously mean more difficult fiscal choices elsewhere.
Yeah.
So we're going to be hearing about that, the fact that we're going to have deeper spending cuts here in the UK in order to meet the fiscal targets, create headroom against the fiscal rules. I'm going to be really interested to hear what the OBR has to say about the near-term outlook, but also the medium-term outlook. I think the likely takeaway at least, although these things we can always get surprised, is that a lot of the tougher decisions are going to be delayed till the autumn. So this feels like a holding statement, an attempt to reassure financial markets that Labour are serious about fiscal sustainability. But I think there are going to be some difficult decisions in the autumn when we're going to have a full-blown budget.
All right, well, let's see if that is the reassurance that the markets are looking for. Dan Hansen, Bloomberg Economics' chief UK economist, joining the program. Let's go back to Westminster and get more on today's spring statement. Bloomberg's Lizzie Burden standing by with a special guest. Lizzie.
Thank you, Kriti. Well, really good to have Dan's framing there as we await that updated Office for Budget Responsibility forecast, as we await the latest policies from Chancellor Rachel Reeves. But we can discuss the framing and some of what we might expect now with Dame Meg Hillier, Chair of the Treasury Select Committee and Labour Member of Parliament. Really good to have you with me, Meg.
Pleasure to be here.
We're expecting the Chancellor to frame this spring statement today as pretty much all Donald Trump's fault. That's why we've got sluggish growth. That's perhaps why the OBR is going to downgrade its growth forecast. Do you think that maybe she should take a little personal responsibility here, though, for her tax rises and the gloomy narrative since she came to power?
Well, look, I mean, everyone wants to come into politics to talk about the sunny uplands, but she inherited a very big challenge. So I think she was being very honest and realistic when she were elected last July and then in her budget. But look, and it is not unreasonable to say that the impact of Donald Trump's election and his erratic approach, the tariffs, his everything he's doing, even in around Ukraine, talk about what he wants to do with Canada. This is all very unsettling for businesses and across the world, and including in the UK. And it's not a comfortable environment to think about future investment with all of that uncertainty. So I think it's completely reasonable that she can point to that. She has also, of course, set out very clear fiscal rules. She was very clear as Chancellor and Shadow Chancellor before that she was going to be a Chancellor setting stability and certainty. And I think that her fiscal rules that she set, she is really clearly not going to move from. She told us that very clearly last November.
And she shouldn't be moving from them because we know she's got difficult choices. She shouldn't be loosening those fiscal rules to give us some more headroom.
Well, she was very clear to us and volunteered to us last November in front of the Treasury Select Committee that she would not be putting up taxes again. So she's very clear that's not going to happen. So really the only other option available to her is to reduce spending. This is something that I've spent a decade on a previous committee looking at public spending. Governments always want to trim this, so it's actually challenging to deliver. But there are opportunities there that can be taken, and some of them will be very hard choices, as we've seen in the last week.
Because she's told us that there'd be no austerity. Isn't that what we're going to get today?
No, austerity was a mindset saying we're going to reduce the size of the state and determine that we're going to do things differently. That was very much a conservative take under George Osborne. We're a government that wants to see investment in public services. And if you look back at that budget last year, it was actually talking about investment in schools and hospitals. We've seen further talk and investment in that. We're looking as a committee at the National Wealth Fund to see how that will instigate growth and investment. So there are seeds of hope there, but it's a very challenging financial situation that she's inherited.
But you'll know, Meg, that there are many in your party, including in the cabinet, who are saying she's choosing fiscal stability over social justice.
Well, government is about hard choices, and she came in and she is Chancellor. Her job is to make sure there is fiscal security. And of course, there are very big challenges in how you do that. We all come in, every MP, whatever party, with our wish list of things we want to see, whether it be in our constituency or nationally. And we all have those demands. We want to see those changes. But until we have stability and economic growth, a lot of those will be hard to deliver. There isn't a magic money tree, and she's really clear about that. So she's set these fiscal rules. She's clear they're not going to change. But actually, they do, chancellors have changed them over the years, but never in the first year, so I do not expect any shift on that at all this afternoon.
On that national security point, just coming back to Donald Trump, the other thing that we're expecting is for the Chancellor to announce more defence spending, because that's what other countries are doing. But is that actually just a bit of fiscal accounting wizardry, because she's cutting the aid budget, putting it on defence, and by her rules that counts as investment?
Well, I mean, I think she wasn't looking at it for doing it from that perspective, because let's be clear, there is a very big need to support Ukraine, and the Prime Minister's lent in very heavily and led on the world stage on that issue. But actually, but investing in defence, it boosts confidence in a lot of industry, because remember, it's not just defence industries, it's the supply chain to them, and defence jobs are around the country. So in terms of actually generating growth, there could be a real opportunity, which sounds an awful thing to say about something so tragic as what's going on in Ukraine, but there is a need to step up, and there is on the positive side for the UK, that could create jobs and opportunities for young apprentices as well.
But by that argument then, Meg, shouldn't she be doing way more? I mean, a couple of £1 billion more on defence is nothing compared to what Friedrich Merz in Germany is promising.
Well, then she's likewise got to look at her overall package and her fiscal rules. She's not going to just splurge. She's not a chancellor who's just going to be giving out money that she hasn't got. And look, she's a very clearly set on this trajectory. She's very clear about her fiscal rules. We will be challenging her, of course, on the committee next week. That's our job, and asking her about what we see today. I haven't yet seen the OBR's latest forecast, so that will determine what we ask. And of course, we're speaking to the OBR next week as well.
Yeah, just on the OBR, the Office for Budget Responsibility, the fiscal watchdog, it's arguably never had such an important role historically, right? Given the focus on growth, given the Chancellor's so, as you say, wedded to her fiscal rules, is it fit for purpose? Do you agree, a bit too optimistic about its forecasts?
No, I think it is a very good organisation that's fit for purpose. And let's be clear, who has lent into it and given it more responsibility? The current Chancellor, Rachel Reeves. She hasn't shied away from having scrutiny and challenge about her decisions and has tied herself to the work of the OBR. But look, these are forecasts over a 5-year period. Obviously, the further out you get, the less certain things are. They would say that too. And you see that with other forecasters as well. So, there were different methodologies employed, but they're very transparent about what they do and how they use it. And it's important that we have that check and balance on the system. And, I'm sure it's not always welcome news for this Chancellor or future Chancellors, but the fact that she has said this is so important, I want to make it even stronger in law, I think is a sign of her confidence that she can be challenged. But we'll be challenging her next week. We won't give her an easy ride because we're there to ask those tough questions that the electorate want to hear.
Well, we'll look forward to that at the Treasury Select Committee next week. Meg Hillier, really good to talk to you, Chair of the Treasury Select Committee and Labour Member of Parliament. Back to you, Kriti, Anna.
Lizzie, thank you very much. Bloomberg's Lizzie Burden in Westminster for us. You can join us for special coverage of the Chancellor's spring statement. That starts today at 12:15 p.m. UK time. We expect the Chancellor to stand up around 15 minutes after that. Subscribers will also be able to watch on the terminal, and we'll be live streaming our coverage on YouTube as well. So many ways to engage with our coverage there. And Kriti, it'll be, as we were hearing from Dan Hansen, could this be something of a holding statement? The markets will be poring over the detail either way. And it could be things she says that moves the market. It could be things the OBR says about their inflation expectations or growth expectations. We've seen that move market expectations in the past, certainly around the last budget. So that's one focus. We're also watching European stocks fade a little bit this morning.
Absolutely. The shares down on the stock 600 down about 0.6%. But the FTSE remains the outperformer, higher by about 0.1%. It's not a massive move to the upside, but certainly one that edges out some of its continental peers as well. It's worth noting as well that we are going to be having a conversation with the CFO of British defense company BAE Systems. They will speak to Bloomberg TV in just over half an hour, talking a little bit about that defense spending story and perhaps a little bit of what we may potentially hear from the spring statement as well. Plenty to discuss on the defense front. That conversation happening in the Pulse next. Markets are selling off. That does it for the opening trade. The Pulse is up next. This is Bloomberg.